Thank you for watching On Point. I'm Nompumelelo Siziba. Transaction Capital released their annual results for the 12 months ended September 2020. The company reported that headline earnings per share from continuing operations came down by 64% to 42 cents. And on this occasion, shareholders are not getting a dividend. To take us through the results, I'm joined via Skype by Mr. David Hurwitz. He's the CEO at Transaction Capital. Thank you so much, David, for joining us. Now, what was your revenue in the period under review, and how much did it go up or down by, and what do you attribute to the 65% decline in headline earnings?
Thanks for having me on the show. We were actually very pleased with results. I think like most companies all over the world, COVID impacted our results, and this impact was really felt in the form of our credit provisions. In our SA taxi business, we have a large lending portfolio, and in TCRS, we collect non-performing debt. And both of these businesses, just like banks, require credit provisions. If we take a look at results before any impact of the credit provisions, we actually grew. So pre-provision profit grew by about 10%. Operating costs only increased by about 11%. So we had positive operational leverage from our businesses. And really what we saw was that in our SA taxi business, our provisions went, or our credit impairments, went from 322 million Rand in the 2019 year to 836 million Rand. So that is the real impact that we felt. But if you look at our sectors, the minibus taxi industry, the used vehicle industry, and debt collection industry, all of our sectors are robust and operating pretty well in a post-COVID environment.
So now that fast forward into the national lockdown, where of course a lot of the regulations have been eased, are you seeing operations performing much better in terms of the SA taxi space? And also, are you seeing people beginning to better pay back the money that they owe to you?
Absolutely. So if you look at SA taxi, what we've always said is that the industries that we operate in are far more resilient than others, first of all. And second of all, that our industries will recover much quicker. So if we take a look at the minibus taxi industry, during lockdown, we saw about 68% of our minibus taxis operating. So we were only down by about 32%, whereas most other industries were either completely shut or dramatically down. What we've seen as COVID restrictions have eased and we've moved into lower levels of restriction, we've actually seen this industry rebound and recover very, very quickly. Where we are right now is almost all of our minibus taxis are operating, and they're driving about 85 to 95% of their normal distance. So a very good recovery, and we've seen this in our customers' performance, that they're actually, from a payment perspective, we're sitting at collecting about 90% of our normal collections. So this industry has recovered very well. If you look at the used car vehicle, if you look at our investment into We Buy Cars, for the months of January and February this year, before COVID, We Buy Cars traded about just under 6,000 vehicles, call it 5,900. And for the months of July, August, September, and October, trading has been above 6,000. So post-COVID trading levels have already exceeded pre-COVID levels. And I think that is because of the fact that as people are under financial pressure, they will trade down from, instead of buying a new car, to buying a used car. And that is where We Buy Cars operate, the used car industry.
Yeah.
And then finally, if you look at our collections business, there we help consumer-facing businesses like banks and retailers and insurers and telcos collect on their consumer debt. And more than ever, people are battling to pay, and these type of clients of ours, banks and retailers, etc., need our services more than ever. And our collections there and activities there have also recovered to almost pre-COVID levels. So a very good recovery in all of our business activities.
So now you speak about having about R1 billion in undrawn loan facilities that you may use for investment down the line. Are you eyeing any further opportunities?
So we've just done this We Buy Cars investment, which will really accelerate our growth prospects. If we take a look at growth in the 2021 year, versus the 2019 year. I'm not going to use 2020 as a soundboard or as a measuring stick because it's just irrelevant. But we believe that in 2021 we can grow our earnings above 2019 levels. How do we achieve that? Our taxi business and our collections business should grow in low double-figure percentages. But when we bring We Buy Cars into the group, we now see our earnings growing again at rates that we are traditionally more accustomed to, low 20s, high teen earnings growth rates. So this investment into We Buy Cars has been very accretive for us. And we have R1 billion worth of facilities to continue doing similar types of investments. But I really think that most of the growth will come from investing into non-performing loan portfolios in South Africa, in Australia, and in Europe. I did want to say that our business in Australia, which we invested into about 4.5 to 5 years ago, has grown really, really well, and that market has performed fantastically.
So I do see that you bought a 49.9% stake in We Buy Cars. Why didn't you buy a controlling interest in it?
Very interesting. This is a high growth business, a business that grew earnings at almost 60% over the last 3 years per year. It is a business which is a mixture of a physical trader of vehicles through physical infrastructure, but also using data, artificial intelligence and e-commerce to trade their vehicles. And the interesting thing there is that Naspers actually bought this business, a 60% stake in this business, almost 2 years ago, and the Competition Commission blocked that deal. I think this was linked to all of the e-commerce activities that sat in Naspers and in this business. Of course, we don't have any of that, but the sellers of the business were just not willing to sell a control position for us, I think based on their experience through the Naspers scenario.
Okay.
So they wouldn't really sell us control. We bought 49.9. They have, the sellers have the ability to sell some more of their shares to us down the line. And also in the occurrence of certain events happening, we might be able to acquire some more. And we do believe that over time, we can get to a control position. Okay. So that's the reasoning for it. And really not so much to do with us, but got to do with the previous failed transaction.
Okay, thank you for that explanation, David, and thank you very much for giving us some insights into the company results. David Hurwitz, he's the CEO at Transaction Capital.